You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today we have Mr. Bernard Reisz with ReSureFinancial.com. He is a tax strategist. He is the chief educational officer with this company. And man, we're going to talk today about not really specific tax strategies. They can do them all. 1031, bonus depreciation, cost segregation, EQRP, anything you can think of, this company does it. But really the topic he wants to share today is make sure you're looking at your tax planning strategy holistically, not just letting like one little strategy drive the deals you're doing, drive the assets you're acquiring, but really think about it holistically, and then holistically as applied to your situation. So can't wait to get into this episode. Here we go. All right, Real Estate Runway family, welcome to another episode of the Real Estate Runway podcast powered by Quattro Capital. I am here today with my friend Bernard Reisz of ReSureFinancial.com. He's the lead strategist and educator, transforming financial paradigms, all things tax and planning related, wealth strategy. Bernard, welcome to the show. How are you doing today, my friend?
I'm doing great, Chad. Really excited to do this interview, and thank you so much for hosting.
Likewise, absolutely. We've been trying to do this for a while, so I'm glad we can finally connect and get on the phone and you know, see each other's faces. This is fantastic. So tell us a little bit about, you know, who you are, what, you know, who your company is, and what y'all specialize in, and then we'll kind of see where the conversation goes. But there's kind of a lot of rabbit holes we can go down with this conversation.
Oh yeah. So what I'd say, what we specialize in is kind of taking all those rabbit holes, as you'd say. And a key thing is really recognizing when people think of rabbit hole, they think of like one place, one tunnel that you can go down, and hey, there are many of them. And the truth is, it's more like a matrix or like a network, right? And it's really about, hey, how do all these things work together? So they're not really independent. They all interact. And that's where we play. And, you know, how do these things come together? And how do they impact each and every investor? Because everybody's different. Everybody's got their own profile, their own goals. And so that's what it's about. It's about kind of networking it rather than viewing them as distinct silos.
I love that. When you said matrix, like all of a sudden I thought I used to have one on my desk, and you guys on podcast can't hear it anyway, or see it anyway. I used to have a Rubik's Cube on my desk. And so I'm picturing like all these connected squares. Each one of those could be a rabbit hole, but really they're all touching, they're all connected, and they can all affect one another. So it's a very interesting paradigm you just mentioned there. Tell me a little bit about who you are. So what got you into tax strategies and wealth planning strategies and things of that sort?
So the way I'm, you know, I'd say at heart, really a scholar, really just love, believe it or not, yes, I enjoy just researching and analyzing stuff. That's really what it is at the core. So really like getting lost in the weeds that some folks never see, don't care to see. Different personalities. I'd say a lot of people, you know, don't enjoy doing the kind of thing that I really love, that I got to have passion for. So whether it's taxes, looking at regulations and case law, or financial products, you know, you talk life insurance policies and different structured products, right? You get hundreds of pages, you know, but really what's going on in there? Let's take this apart, figure out all the moving pieces. That's kind of where I've come from in terms of a background. And then it's transitioned into, okay, let's try to educate folks about this and hopefully alter those paradigms so that they can kind of get the same integrated viewpoint.
That makes sense. So let's kind of get into the meat a little bit. Let's talk about that integrated viewpoint. So ReSure Financial, you know, you're focused on helping professionals or investors rather, you know, employ all these little rabbit holes we talked about, these little miniature tax strategies like the qualified retirement plan, like 1031 exchanges and things of that sort. But you mentioned in our prior discussion that one of the biggest problems that you see is people, you know, kind of honing in on one of these rabbit holes and trying to use that to drive the decisions on an asset purchase or something like that. Like how are you guys helping people look at this more holistically and try to understand the bigger picture,
Yeah, let's do it. And we'll use like more concrete examples. We can do it with every single one of these. But let's say 1031 exchanges. So 1031 exchange, and it holds true for cost segregation and self-directed retirement plans. Yeah, there is a certain amount of paperwork that has to get done to make it happen. But the real heavy lifting is understanding how it's going to impact any particular individual's tax profile. So 1031 exchange, get that paperwork processed, easy enough, right? But the real legwork is, firstly, calculating what is the real net financial benefit of doing the exchange, right? There is a cost to doing an exchange, and there's a benefit to doing an exchange. That's got to be calculated. So believe it or not, and I give you this an example as an egregious example.
I love examples. Let's go.
1031 exchanges, people think of 1031 exchanges as a way to avoid capital gains, right? Recognizing capital gains for tax purposes. But really what it does, it avoids recognizing kind of the transaction at all. So it goes both ways. You can avoid recognizing a gain, avoid recognizing a loss, right? Now we know nobody likes to have a loss, but if you have one of those, you want to recognize it, right? And everybody wants to have a gain, but nobody wants to recognize that. 1031 says whatever the results of this transaction are, right? It won't be recognized. Well, we've seen people that are in the market to get a 1031 exchange done, and they'll call us up and say, oh, we spoke to 1031 QI A or B, and we're ready to do this exchange, and we just want to know, all right, what's your pricing? How do you compare to them? And then we're going to talk to them a little more, and we may realize that, hey, you actually don't have much gain to defer, right? So we've actually seen people that have deferred a loss, right? They had this thing in their head: when you sell real estate, you do a 1031 exchange, right? And sometimes calculating gain on loss on real estate can be a little tricky, right? Because with real estate, you depreciate, you have an adjusted basis. A basis can go up and down for tax purposes. And sometimes it's not exactly aligned with the way an investor thinks about it from a financial perspective. So before you do a 1031 exchange, you need to analyze, okay, what would I look like without the exchange? What would I look like with the exchange? And sometimes the folks that provide the services, right, are not looking at that holistically for you. Another thing is, really, how do you calculate the true benefit of 1031 exchange? If I were to ask you, if I may, Chad, how would you calculate what's the benefit of a 1031 exchange?
Wow. So going back to your holistic example, let's see if I can not fall into the bear trap, right? How do you calculate the benefit of it? So I think case number one is, right, do you have a gain to defer? And if so, how big? And for me, I would go look at, okay, well, if I took that gain, what is my overall tax liability on that gain? And that's going to be variable, right? Because if you bought something with super low basis and are making a massive gain, it's significant, but maybe you're more marginal. So I would actually look at that. But from that perspective, I'd also, for me, I'm a real estate professional. So it doesn't always make sense for me to do a 1031 exchange because I have other losses that I can use to offset my capital gains. So for me, it's always a question of, man, I hate burdened money, right? Money that's stuck in a 401k plan, money that has tax rules of now I'm stuck in the system and it just gets bigger and bigger and bigger. I'd much rather keep my money out of the system if I can, not out of the system, out of the cumbersome or being burdened if I can. So for me, that's how I'm looking at it. But I don't know if that was the answer you wanted or not, Bernard.
Yeah, no, that's awesome. That's amazing. And I'll get to what I was trying to get to in a minute.
Sorry, I swung and missed. Go ahead.
No, that's like a triple. Right. You got that's third base. So absolutely, all this stuff that you said is amazing, right? Real estate professional, everybody's impacted differently. There's so many folks out there that are saying, hey, I heard this thing about real estate taxation. And they're like, that's only if you're a real estate professional, or vice versa, right? Yeah, that's only if you're passive. And sometimes the stuff that's out there on the web doesn't distinguish between these kind of things. But really, it goes back to a lot of these tax strategies are not tax strategies. Everything is driven by the economic and financial outcomes. So sometimes the downside of that is folks can make a less than optimal decision because they're focused on the tax side, and they can do a bad deal, right? You don't want to be a 1031 exchange and feel like, all right, there's, the pressure is on, and you don't want the exchange to fall through, and you do a deal that you otherwise wouldn't have done, if not under that pressure. But there's another side to that. The real value of an exchange is in the financial side, not really in the tax side. Because as you said, let's calculate the tax savings. And you got really far and had a look at that. Yes, number one, calculate what the true taxable gain would be. Secondly, what would the tax bite be on that, which varies, right? Are you in a capital gain? Are you 15, 20% net investment income tax, which may add another 4%? Do you have losses that will offset that?
Right.
That's the tax math. But say we arrive at some sort of net savings, which is going to vary from investor to investor, deal size. But let's use a round number. All right. There would be $1 million of tax savings, suppose, right? Let's use a round number. Now, some folks may say, hey, $1 million tax savings, that's nice, but I don't want money in the system, because Chad, you're 100% right. There is getting the tax benefits that the IRS has given us always comes with strings attached.
Yes.
Right. And anytime you're trying to advertise no strings attached tax benefits, it just means you're not seeing the strings to take a step back. Always strings attached, and you got to play the game, play within the system. But all right, we've got this $1 million. Somebody may say, I'm just going to pay the tax. This way I have free money. I'll make objective financial decisions without having the pressure that the system creates. But the real value on that is, number one, it's really the returns, right? When you go into a deal, right, you're not just, you're going to take that money, that $1 million, you would put that in a deal, right? So you're losing the return on that investment, right? So you're losing the future return on that capital. And not only that, the future compounding. And seeing the impacts of compounding, the only way to really visualize that is to kind of see a graph, because it is so powerful that words can't do it justice. So there's if you look at a graph on returns that you're paying taxes on and returns that you're not paying taxes on, or fees, whatever kind of thing is coming out every year, right? After 10 years, 20 years, that goes in the beginning, it kind of looks like that. And then it starts going straight up. And the difference between, what you're having a bigger nest egg to start with gets to be hundreds of percentages or thousands of percentage points difference over time. So when you save taxes, it's not the taxes. It's not that $1 million or $100,000. It's really the return on that money that you could have gotten over time. So $1,000 in tax savings today is not really $1,000, right? $1,000 is tens of thousands of dollars over a lifetime. $1 million saved is tens of millions, over decades of investing that without paying the tax. But we take it a step further. That's all good. We can talk about compounding when we talk about the stock market. But now let's take this to real estate, where this gets just turbocharged, right? With $1 million of cash, you can get $4 million of real estate.
Leverage is a beautiful thing, isn't it, Bernard?
Oh yeah. Right. So
You don't believe me, guys? Go try to buy stocks at for get $4 for one. That doesn't work very well. But anyway,
and
keep
so
going.
if you, yeah, I see you couldn't resist that, but that's
Couldn't.
absolutely, it
Keep
is.
going, man. I'm not dogging any asset. I'm just saying
Oh yeah,
leverage is a
no, I
beautiful thing.
see that. I'm with you. It's like, it's insane, right? You can get, so if you take that power of leverage and you take that to your 1031 exchange, right? $1 million in the pocket means another $4 million of real estate. Right now, let's think about that. $4 million of real estate, you got the returns on that, right? So $1 billion of real estate in the pocket, additional capital, right, means compounding on $4 million of real estate, right? And you can keep doing that. That is super powerful. And so this is one, it is so powerful that to a certain extent, it can dictate investment decisions, right? It's got its limits, but it is powerful enough that it really can, to a certain extent, right? Yeah, okay, pay a little more for the deal so that you have that $1 million to go in, right? And to get another $4 million of real estate. So it's really viewing it financially more so than viewing it from a tax perspective, right? If you kind of get your tax blinders on, then it's always like, okay, tax savings is just $100,000, or it's just whatever that is to the individual. But when you view it holistically, and a more like holistic financial sense, rather than viewing it as like, okay, what's the tax return going to look like this year? That's what the real power of tax strategy is. And so I try to tell folks, like, 1031 exchange is not a tax strategy. It's a real estate financing tool. That's really how I look at it.
I think you're so right. I mean, and just everything you've been laying down right here, your tax strategy is really not something to take, a screwdriver, a hammer, maybe a saw, and whatever other tool you have, and just use it all the time. And you may get really good at hammering in nails, and you may get really good at sawing wood in half. But, sometimes the piece you have, I'm just using analogies here. Sometimes the piece you have winds up being a harder kind of wood than a soft kind of wood. Maybe you no longer need to use that handsaw. You need some kind of a electrical tool. So I think the biggest thing you're trying to point people in direction of is like, understand all the tools, understand all the strategies, understand, have a professional to help you with them, such as Bernard and his team. But the biggest thing is knowing at least the high level particulars about your particular situation, and on a deal by deal basis, what the tax liability will be. Because even in your own unique 1 in a million tax situation, because that is the problem. No one's willing to give you tax advice that's running your investments, because you are one of the investors, and you have an exactly polar opposite strategy to probably all the other people in the investment. So understanding the 2 or 3 things about your tax position, about your, whether you're a real estate professional or not, or whether or not you can write off certain losses against certain income, it's going to help you make better decisions. And then further, don't let the deal drive the strategy, or the strategy drive the deal. The deal's got to drive the strategy. Does that sound about right?
You got it. It's really recognizing that, take the broad picture, see the big picture, see the trees, see the forest, and then see how they come together. It's not siloed, and everybody is unique.
That makes sense. Well, I'd love to ask maybe a current question. So it is currently, at the time of this recording, it is April 26, 2022. So we've had some interesting times lately. Everyone's talking about inflation. Everyone's talking about interest rates. Everyone's talking about capital gains taxes going up. I'm curious if you with your client base, if you're seeing any shift in behavior, maybe any new strategies being used, or if everyone is kind of still, using the same tools in the toolbox and waiting for things to change. Anything new you'd lay on the table?
So we do see, some acceleration, and folks sometimes say making a move if the time is right, to take advantage of benefits that are here today, that may be gone tomorrow. This is something we talk about a lot. One of the things we did, again, we did like a very extensive series on some alternative strategies that are out there, but we've cautioned people about them. So we're experts in a lot of strategies, even the ones that we don't execute. And some of them, what we love about the stuff that we do focus on is that they're kind of there in the tax code, but the IRS telling you how they want it done. It's not about, saying, hey, we can take section A, B, and C and kind of reconfigure it with a new outcome that Congress never intended. Because that kind of thing, more often than not, tends to not turn out that well once the IRS gets wind of them. So there were certain, 1031 exchange, self-directed retirement accounts, cost segregation. These are all stuff, again, Congress may change the rules on us. Hopefully they won't. But for as long as they're there, this is as above board as it gets. And that's the beauty of real estate, frankly, is that we have these tax tools that are right there in the code and the regulations. Yes, they can be abused, but so long as you're not abusing them, you can be super comfortable with these tax tools. In contrast, if these do go away, it will bring into focus some other things that are promoted that have some inherent risks in them. It's never fun to be the naysayer, but there's stuff that we've cautioned people about for years, be they various installment sales strategies, syndicated conservation easements, things in self-directed retirement account space that we've cautioned people about. And there's occasionally you get some sort of bittersweet vindication when the IRS actually says, hey, we're going after this. So there are certain things that we'd say, there are alternative strategies, but we'd say caution is advised. In terms of trying to take advantage of current rules, we'd say if you have a deal that makes sense, and you may be waiting, to get a slightly better deal, okay, maybe pull the trigger now and take advantage of what's in play. But if you wouldn't sell, don't sell something because you think 1031 is going away. Don't make rash moves. Again, don't let the tax tail wag the investment dog. It's really good deals, good investments, good assets. That's the main driver. But if yes, you were in a frame of mind questioning, maybe you're ready to sell, maybe not. All right, this can be the tipping point, but it can't be the driver of the decision.
We're going to let that be. If I could pick this, actually, I see your mic right there. Will you pick it up for me and just drop it on the table?
Yeah, mic drop.
Because that's so wise. I mean, what he's saying right here, and I see a lot of people doing this. Even investors of ours are asking us, hey, should we sell this deal that we're in? No, we're halfway through the value add play. We're not near at peak equity. I don't care if 1031 is going away. We're going to be leaving money on the table if we do that, right? Always let the dog wag the tail, not the other way around. That's totally it. Wow, Bernard, I've really enjoyed this conversation, but now I've got to take you to the Quattro Trio and ask you a couple of questions just to learn a little bit more about you and maybe get a couple more last minute nuggets for the audience. What do you say?
Let's do it. I love kind of that play, Quattro Trio, the number play, the words there.
The whole thing was an accident. It's actually an accident that we're named Quattro Capital, but we had an entity name and it worked. So here we go. That's a story for another day, folks. I'll do a podcast on it. Bernard, so tell us, what is your superpower in this industry?
The superpower, if I'd have to say, is really focusing on integrating execution and education, right? What we tend to have is some folks doing education and advisory and other folks doing the execution. And I think that leaves a huge chasm, right? Because the folks that are just promoting the paperwork, right, are not going to help you address the big picture. And the folks that are selling the advisory services, they're not really involved in the execution. You'd be amazed at how many people do these things, execute various tax strategies and tools without getting, the full picture from an objective advisor. And the other thing is, it's very hard to really be an expert in a niche strategy without actually doing it. There's just a limit to what you can get from reading tax code, right? You got to get your hands dirty to really, and deal with folks day in, day out, to really be able to give people the comprehensive support that they need. And I'd say that's our superpower.
You were so right. And I think I'm really glad to know that. We may actually need to set up a call, but yes, that is fantastic to know that those who are doing the strategy are also the ones teaching it. That's not always the case. All right. So jumping to question number 2, Bernard, we've heard a lot of reasons why you're very intelligent in the space and why you're awesome in life here, but man, give me some dirt. What is your biggest lesson learned or failure in life? And what did it teach you? Business or life, either way.
I'd say I think business and life are kind of one and the same to an extent. More and more realizing business is just one little microcosm of broader macrocosm that life is. I think it's important to kind of be able to meet people where they are, and be able to see things from other folks' perspective. I'd say professionally, sometimes I kind of take for granted that people, you live in a space, you live and breathe it, and you forget that, hey, not everybody's living and breathing this stuff, right? You got to meet people where they are. I think that's a key lesson, and maybe somewhere where I've failed, and a lesson learned.
That's super powerful, Bernard, because I think, one of our common sayings is confusion of the brain says no. And if you don't meet someone where you are, they may just shut down, and then you're not helping them make the best decisions for themselves and their tax liabilities. That's so wise. I love that. Okay. So question number 3, and then we'll let you get back to your amazing and awesome day here. We at Quattro are pretty big on the word philanthropy, right? As one of our 4 pillars here at Quattro. And we love letting our guests mention any philanthropy that you support and why, because a lot of times our listeners who are also sharing this sentiment will support on your behalf. So if you had to pick 1 or 2 philanthropies that you tend to support, what are they and why?
Yes. So I got a response to that. It may not be the response that you were hoping for, but maybe it'll create a bit of a, possibly some sort of paradigm shift. So philanthropy, as you say, is super important, super powerful, and powerful in terms of satisfaction, fulfillment, and philanthropy exists. We got to ultimately, are we giving or taking? And I think we end up happier when we're giving as opposed to taking. So 2 things that I'd share. Number 1, I think sometimes there's like this perception that philanthropy and business are kind of 2 different domains. But truly, the goal is to be giving in whatever we do, right? And so in your business, right, it's not like, oh, the business is where we do the taking and we do the giving elsewhere when we give philanthropy. You really want your business almost to be where you're doing the greatest amount of philanthropy. You want the value that you deliver to be just well above, right, what you're getting paid. And it is totally doable in the financial space where what you're delivering is something that's abstract, right? And you're getting is a fixed fee, right? And so when something is abstract, you can be saving people from incredible potential pitfalls that it can be really costly and giving them upside that is incredibly high. So the first thing I'd say is philanthropy is really hopefully something that we do in everything that we do. Secondly, I don't have a particular organization I'd say I focus on, but what I do try to do is, there is a saying that charity begins at home. But the idea is really looking out. There are organizations that do amazing things, but there are also individuals all around us that need, sometimes it's dollars and cents that they need. It can be other things. And they may not have the benefit of an organization that is going to help them. Some of it may be because, hey, they don't fit inside of a certain organization focus on. Sometimes it could be because of personal limitations or pride, right? But people, they need that assistance and they're falling between the cracks. What I would love to encourage people to do is look for people in their immediate community that can actually benefit and are not getting helped elsewhere. You may not get a tax deduction because it has to go to to get the tax deduction, you need that 501c3. But you probably have the greatest impact and the biggest ROI because, hey, none of it's going to marketing costs. It's like, hey, you need some money? Here you go. And it's directly to the ultimate recipient. I think that can be the most gratifying form of charity that's really out there. You can see the results. It's not as if, and not to say that, everything else is amazing, but I think that sometimes that type of charity can be somewhat neglected in exchange for giving it to some huge organization.
I love the paradigm shift there. And I mean, it's very clear that you have a servant heart, and it sounds like that's really the spirit of your company as well. So, wow, if any of the listeners are as empowered by that as I am, how can they reach out and get in touch with you? Just have a conversation about anything we've mentioned today, or even to seek strategic advice in wealth growth or tax planning?
Yeah, glad to share that. So we've got a member space, which has lots of educational videos, tax resources, but it really, obviously 1031 exchange, self-directed retirement accounts, cost segregation, but also on stuff that we don't do. So life insurance, estate planning, kind of a lot of fun stuff, things that we see there's a need for people to get objective info about. That's at members.resurefinancial.com. So our website is resurefinancial.com, RESURE financial.com. Right there, there's a link to investor education, free space, lots of stuff. You got to be ready to nerd out a bit because it gets into the weeds, but it's information that we see, the kind of things that we see come up again and again and again. So we've created content there for folks to go through.
Fantastic. And folks, as always, that will be down in the show notes. So don't feel like you have to write it down. Just scroll right on down in whatever modality you're listening or watching on, and it's all right there. Bernard, thank you so much for coming on the show. Multiple mic drop moments, multiple quotable moments. I can almost guess what the title of the episode will be based on some of them. So thank you for coming on. Really appreciate your time. And until next time, this has been the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.